Alright, so in this video, I wanted to talk about the risks of selling calls. And the reason I wanted to talk about this because of what has been going on with GameStop, and because I almost got myself in big trouble with this stock, and I'm going to explain. And also because I know a trader that actually lost almost, I think, $160,000 US by selling calls on BlackBerry, not GameStop, but BlackBerry, which basically did the same thing as GameStop and AMC. So I'm sure you know by now the story of GameStop. It's all over YouTube, it's all over CNBC, it's all over all the media channels. But I wanted to talk about a trade that I almost made. So before any of this happened, before GameStop was trading at $325. So if you watch my videos, you know that I like to sell options. I like to sell puts on red days. And sometimes I like to sell calls on green days, but obviously short term. I don't like to be short a naked call too long. If I'm short a call, it'll be, for example, on earnings. So it's just a 1 day trade, or maximum a 1 week trade. So January 15, GameStop had a high of $40, but it closed the day at 35. That's a Friday. So that's an options expiration. And then January 19, which was a Monday, you could see that the stock opened at 41. It had a high of 45. So let's go back. Friday, January 15, it closed the day at 35. On Monday, it opened at 41. So it opened 6 points higher compared to Friday's price. And it had a high of 45. So percentage-wise, 45 divided by 35, let's see what that gives us. 45 divided by 35, that's 28% higher. So on Monday, January 19, GameStop opened 25% higher. So to me, I was very tempted to sell a naked call on GameStop for the same week expiration, which was January 22nd. The only strike available on Monday was the 60 strike, and it was worth $1.30. That's the order that I was going to place. So I was going to get in on this trade for $1.30, one contract for January 22nd. That would have given me $130. So I didn't place the trade, but I was very tempted. I even talked about it to a few people. I was going to place it. It seemed like a very good trade. AMD opened really high. In my opinion, it's not going to keep going up. This is before me knowing anything about GameStop and Wall Street bets. So I didn't place a trade, but look what happened. Next day, GameStop had a high of only 41, dropped to 36. January 21st, which is a Wednesday, closed at 43. Sorry, January 19 was a Tuesday. So 21st was a Thursday. It closed at 43. Remember, my strike in this case was a 60 strike, a naked call, selling a naked call. So when you sell options, when you sell a call option, it's the opposite of buying a call option. When you buy a call option, you make money if the stock goes up. When you sell a call option, you make money as long as the stock stays below your strike come expiry. So it doesn't necessarily have to go down for you to make money when you sell a call option, but it just has to stay below a certain strike, and then you make money by keeping the credit that you collected, because the call option that you sold loses value as time goes. So day by day, the call option loses value as long as the stock stays below your strike, and you end up, and the call option expires worthless, and then you end up confirming your profit. So January 21st, the stock closed at 43. So at that point, the call option was trading for about less than 10 cents. So I almost sold it for $1.30, and it was trading for 10 cents about. So the risk is the next day was the expiry, January 22nd. And look what happened to GameStop. It opened at 42, not bad, but it had a high of 76. And it closed at 65. Now, imagine if I got into this trade January 19, and come January 21st, I see that it's worth 10 cents, but I also see that it's trading at 44. It's 15 points away from my strike. What if I were greedy and decided to just let it ride to expiry so that it expires worthless, so I don't have to pay commissions to close the trade? I would have been in big trouble because it closed at 65. Remember, my strike was 60. So that means my call option that I sold for $1.30 is now worth $5. So I would have to either take the loss, but most likely what I would have done is I would have rolled it. So I would have bought it back and then sold, let's say, the 75 strike if it was available. I don't think it was available then. I would have probably sold the same strike again at 60, the 60 strike for next week. So for next Friday's expiration, which was January 29th. So most likely I would have sold the January 29th expiration, same strike. And I would have collected a credit for rolling at the same strike. I would have collected a credit, let's say, $1. And look what would have happened. The stock is now trading. It closed January 29th at $325. So that would mean that just to collect $1.30 the first time, that means I would be down $325 minus the 60 strike, minus the $1.30 that I collected, minus the $1 that I collected for rolling, $262 times 100. That means I would have lost $26,000 on this trade if I had sold the naked call on GameStop January 19, which I was very close to doing. And maybe I could have avoided all this if I had closed it January 21st because it was worth 10 cents. Now, looking back on my trades, I tend to close my trades. I don't like to hold it to expiry. But sometimes when it's very far, I'll let it expire worthless just to save on commissions. Like my Netflix put spread, I let it expire worthless because it was almost 100 points away. I don't know what I would have done. Most likely I would have closed it, so it would have been safe. But imagine if I got greedy that day and I decided to just let it expire worthless. Look at how dangerous this trade could have been. So that's really the risk with naked calls, is that there's no limit to the upside. Basically, you have infinity. There's no cap to how much you could lose if the trade goes against you in terms of selling calls, not buying calls. I'm talking about selling calls. At least when you sell puts, the limit is 0. The stock can't go lower than 0. But it's also very unlikely for a stock to go to 0. If you're selling puts on quality stocks, it's not going to go to 0. It could drop below your strike, but eventually it comes back up. So selling puts is not as risky as selling calls, but selling calls, because there's no limit to the upside, as you could see in this example, you would have been completely screwed. Especially selling calls on small price stocks is not a good idea, or low market cap stocks, because they tend to have more potential of flying or going through a short squeeze, as you could see here. Maybe selling a naked call on Netflix is safer, or Nvidia, but even then, anything's possible. So after seeing this, I'm never going to sell a naked call again, even if I'm very confident that the stock won't surpass it. Because I've learned today that anything's possible. And what if I didn't hear about this Wall Street bet thing? And because then I'm forced to really be on top of my stock that I'm selling a call on, and really be aware of all the news, everything that's going on with it, to make sure that there's no possibility of something crazy happening. But I mean, that's just more stress, more work, and sometimes you could miss something. Now, here's the trade from a trader sent me his trades where he lost, I think, $160,000 here. So he had sold the June 18, 2021. Well, this is after rolling. Initially, his first short call was at $10, but then it got breached, so he had to roll. He ended up rolling to June 18 at the 15 call, and January 21st, 2022, the 22 strike on BlackBerry, which did the same thing, almost the same thing as GameStop. And you could see here, he ended up closing the trade. So closed P&L, you could see up here, ended up closing one of them for 114K loss and 38K loss. Now, why is the amount so high? The trader had, I believe, 800 contracts. So there's a bit of a risk there, or bad risk management, because the sizing was terrible. I mean, 800 contracts, just because the buying power or the maintenance excess, the capital required to place this trade was very small. The trader felt like he could place more contracts and collect more premium. But in this really unlucky, weird scenario where the stock decided to fly and go through a short squeeze, you could see how dangerous selling naked calls is. Now, if you are going to do a naked call, make it part of a strangle. So it's a naked put plus a naked call, and make it on normal stocks or even an ETF. So at least there's less risk that the stock flies on you. So maybe avoid naked calls on individual stocks. But if you are going to do it on individual stocks, make it a strangle. Make sure you have the buying power. Make sure you have a plan in case something crazy like this happens. And make sure you understand what the risk is. The risk is basically unlimited. And if you have more than one contract, and if you have, let's say, 800 contracts, like the example with BlackBerry, it's basically infinity times 800. Now, if you were ever stuck in this position, you did a naked call and the stock flies past your short strike or is getting close to it, and you want to sort of get out of the trade, but you don't want to buy back the naked call for a loss. One way to mitigate this is to buy the shares. So if you sold one naked call, then you can buy 100 shares of the stock, of the underlying, to turn the trade into a covered call. So by buying the shares, you basically cap your loss. Your loss is capped at the price of your shares and the difference between your call strike. So let's say, for example, I had sold January 19, I sold the 60 strike. And then I saw on January 22nd, the stock flew to 65. But I don't want to pay $5 and close the trade for a loss because I sold it for $1.30. Buy back for $5, and then I'm confirming a $3.70 loss times 100. Now, if I rolled it, let's say I had rolled it to next week and I kept the same strike of 60. So I'm sold the strike of 60, but I collected an additional credit, and I'm assuming, okay, next week the stock's going to drop. This is ridiculous. It's not going to keep flying. But then Monday, January 25th opens, and the stock is trading at 96, or even had a high of 159. It had a low of 61 though. I don't know when that happened, but yeah. So let's say that happened. I wake up on Monday and this happens. The only thing I could really do is either I buy back my short call for a loss, or I could buy shares. I could buy 100 shares of, let's say I was able to catch it. I don't want to say I caught it at 159. That would be terrible. So the open is 96. So let's say I buy the shares at $100. So remember, my naked call, my strike is 60. So I'm down 40 points now. If I buy the shares at 100, that means I cannot lose more than $40 times 100. So I can't lose more than $4,000 in this case if I buy the shares at 100 and turn it into a covered call. But I end up spending $100 times 100 shares. So that's $10,000. So do I really want that? Do I really want $10,000 invested in this position? But I'm putting $10,000 to save losing even more, to confirm a loss. And basically what I could do in that case is try to roll my 60 strike to a 100 strike. The naked call that I sold at 60, try to roll it up to 100 for a credit. The only way to do that is that you will definitely have to go to a further expiry, like maybe even 2022 or 2023, just to be able to roll your naked call from 60 to 100. And then in that case, you're safe in terms of the upside, no risk to the upside anymore. There's worst case scenario, you'll end up selling your shares at 100, but you bought it at 100, so there's no loss there. Now the risk becomes on the downside though. So what if the stock comes back down below 30 like it was normally trading at, or even below 20? So now you're holding a $100 stock. You bought 100 shares, so that's $10,000, and it's now worth $30. So that's the other risk. So you can't completely protect yourself. So you have to decide, do you want to protect against the upside or do you want to protect against the downside? But that would be one way to mitigate against a naked call that gets completely breached. Ideally, it would have been better if I was able to catch it on January 22nd. Let's say I see the stock close at 65. I'm worried about it, so maybe I'll buy shares at 65. So now I'm only 5 points away, which is $500. I also only spent 6,500 instead of 10,000, and I could easily roll from 60 to 65, and then it's a different case. So it also depends how early you act. Honestly, there's no right approach, there's no perfect answer, but basically buying shares would be the opposite trade of selling a naked call, so they sort of cancel each other out. But you can't control the timing. That's the problem, because by the time you decide you want to buy the shares, your short strike is probably already breached. I hope you appreciated this video. If you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also, check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.